Welcome to TheoTrade. This is Don Kaufman. Here we are. It's January 22nd, 2018. Here we are doing the Theo Night video with just about 20 minutes left in the trading session. The S&P's smoking once again to the upside. Here we are, up some 1750. All-time high in the S&P's, all-time high inside of the Nasdaq, up to 0.8%. We've got a little bit of the Russell lagging right now, but hey, the market this weekend stared down the face of uncertainty and laughed at it. You know, speaking of uncertainty, all politics aside, the government shutdown looks like it's all but over. But in other news, and there was actually a really big piece of news that took me by surprise that it was not an impact to the marketplace, but allow me to describe this to you. So the IMF, the International Monetary Fund, turned around and produced a report. The IMF said that global growth is likely to increase. That is an extraordinarily positive thing. That increase, again, all politics aside, that increase is going to be caused by the U.S. ultimately tax plan that is now in place. Okay, so U.S. changes up their tax implications. The markets are exploding to the upside. The IMF actually upgrades. Then the IMF turns around and starts to detail what? Ultimately, that valuations of global markets, specifically talking about equity valuations and bond valuations of global markets, are incredibly inflated. And that the biggest risk moving forward to the global economy is actually, the equity and bond values themselves. That's fairly shocking that they said that. And again, markets unintimidated by that. So think about this, if you will. The biggest risk to the actual economy is an inflated marketplace that places like the central bankers and the IMF created themselves. Now, enough said on that front. The market stared at it, and just continued to explode higher. Now, let's get to a little bit more of a strategy discussion. This entire week here at TheoTrade, well, we're doing what we term Strategy Week. And in Strategy Week, we are going to select a number of key strategies, including like today, we were talking about selling spreads. Tomorrow is going to be a little bit about iron condors. But I've had a lot of emails also lately about iron condors, and I'm going to give you a little bit of preview of one of the strategies that's going to be discussed tomorrow. And it has to do with iron condors. The emails I'm getting lately are questioning like, hey, you know, I want to go back and I want to sell some options premium. And what I'm going to be detailing in tomorrow's session, which happens to in effect be iron condors, is what we're going to term duration iron condors. And well, effectively, what is duration iron condor? Well, rather than looking at the short duration options and trying to sell 35-day options, and here we are in the SPX, we're going to go out and we're actually going to use a little bit more duration. Why? Take a look if you're out 100 days or 88 days and take a look out about over to the implied volatility side of things. Again, a little bit more duration, right around that 100-day mark. Volatilities are all the way up to about 13%. Now, all factors being held equal, if the market stayed flat or even rallied, we would likely see over the next 30 to 60 days, what's going to happen is volatility is going to drop. How do I know that? Well, look, here we are, 90 days out, 98 days out. Then just look at options, the same options, right? It's the SPX. Then look at options that are, 40 days out. And you'll see that implied volatility is going to drop off by a full almost 2 points. That unto itself can be quite effective. And you can sell options far enough out of the money where the drop in volatility can help quite substantially. Now, allow me to display a little bit of this to you. So I'm going to build one of these duration iron condors. And to do so, listen, I'm just going to ballpark some strikes. I'm going to get into intimately, like every nuance and detail in tomorrow's session. Because you're going to ask, why do I use these strikes? How far out do you go? This is everything that I'm going to be covering in tomorrow's session. Anyway, I'm going to go out here. I'm going to sell initially these 2980s. I'm going to buy the 2990s. That's about $155 out of the money. Well, I got to go out and I got to do it also on the put side. So on the put side, let's cruise out over here to the 2670s, we'll sell those, maybe buy the 2660s, buy those. Trades pricing for a mid price of a $2 credit. I'm going to right click, come over here to analyze the trade. Boom. All right. So we're over $150 out of the money. But the aspect that I want to show you, yeah, you're collecting a $2 credit and a $10 wide spread. The trade, okay, here's the whole key to this trade. What can you make? $2. What can you lose? You could actually lose 8. But we have a hedge that we can put in place for this. Now, what I wanted to show you is if you just held this trade, and you held the trade for even a month, okay? First of all, let's assume volatility drops by about 2 full points. Why am I doing that? Because again, even if you're holding the trade for about a month, the 88-day options, let's hold them until they're like what? The 53 or the 66-day options, you'll see that volatility drops, okay, pretty substantially. So if we drop vol by a full 2%, you're already up 42% on the trade. But I'll tell you what, I'll even be more conservative. I'll only drop volatility by 1 full point over here, which I would see profitability of about 22%. But then we can fast forward a couple of days in here. Let's fast forward, excuse me, just a month. So here we are, January 22nd. Just fast forward exactly a month, February 22nd. And I want you to see that this strategy is already hitting 50% of its potential, right? Which is not a lot, but you're not assuming a tremendous amount of risk over the next 30 days. And if you are a little bit cautious to the downside, you're like, wait, I know the market can explode higher, even at 155 points. Listen, you've seen this marketplace rip higher, all right? I think we all can agree, and I'll even turn these off. You can see the market rip higher. Nevertheless, you could see this marketplace coming from a mile away. And if it started to run against you, of course, you could exit the iron condor. Now, what scares us in this trade is some of the risk to the downside. But that risk to the downside, well, people, that risk to the downside in this iron condor can be countered by trades in the VIX. And we happen to create a trade in the VIX that's out in the March expiration just the other day. And here is effectively that trade in the VIX. If the markets crash and burn, we have a VIX trade that we actually put on for roughly even money or even a credit, okay? And that can help reduce the risk of the iron condor to the downside. Now, I know that this is a lot to think about, right? But again, we're trying to put the pieces of the puzzle together so that you can create effective sell side and premium sales strategies, even in what appears to be one of the more dull markets. As I kind of continue here, S&Ps with just 10 minutes to go in the sessions, just exploding higher once again. Here we are, up 20. I hope you join us for the remainder of that strategy week out there, or find it in the TheoTrade archives. Have a wonderful evening, everybody. Bye-bye.